If you bought a median-priced home in 2020, which back then was $322,600, it would now be worth $417,700 on average. Now that is an increase in value of about 30% in just 3.5 years, a rate of increase that takes us far above the trendline house price growth that we have seen for the past several decades. And this is despite the drop-off that we have seen in house prices starting at the end of 2022. Meanwhile, over this same time period, we have witnessed the Fed hike interest rates at the fastest pace in history, which has in turn caused mortgage rates to more than double, close to being triple what they were in 2020. Now, home prices and interest rates both surging simultaneously is unprecedented and has led to a truly unsustainable increase in how much it now costs to own a home, which has put housing affordability at record lows. Here we can see that the average person now needs to spend 40.5% of their income on their mortgage payments for a median-priced home. And this portion of income that is needed today is far higher than pre-pandemic, where it was more in the 20 to 25% region, and now even exceeds the peak that we saw during the global financial crisis of 34%. You'd have to go back as far as the 1980s to find a time period where housing payments cost this much relative to the average person's income, and the sharp rise that we have seen in this ratio is just not sustainable. Meanwhile, the average cost of renting has increased too, but at a much slower pace compared to home ownership costs, meaning that there is now a 52% premium on buying a home versus renting one. This is the highest the premium of home ownership has ever been in history, and once again points to how unaffordable home ownership is today. As a result of these current market conditions, we are seeing the number of existing homes being sold fall off a cliff in recent months to the lowest annual number in nearly 30 years. Year-over-year sales are down 6%, which came in weaker than economist predictions, while on a monthly basis, December sales fell by 1% from November to a seasonally adjusted rate of 3.7 million. This is a major warning sign for the housing market because historically we have seen existing home sales be a leading indicator for house prices. This chart shows both existing home sales and median home prices relative to CPI, clearly showing how strong this relationship has proven to be across decades of history, with existing home sales leading home prices by roughly 6 to 12 months. Starting in the 1970s, where existing home sales peaked in December of 1978, while median home sale prices didn't peak until 5 months later in April of 1979, before both falling sharply. Similarly, in the run-up to the global financial crisis, we saw existing home sales peak in October 2005, but home prices didn't peak until over a year later in January of 2007, before both metrics also fell sharply. Even when we look at the most recent data for both metrics, we can see that existing home sales looks to have gone through a double dip, where we dipped initially before spiking back up and then absolutely crashing. Looking at the pattern that median home prices relative to CPI is making right now, it does look set to follow existing home sales down, but lagging behind. And when you look at existing home sales compared to the Case-Shiller Home Price Index, another very well respected metric of the housing market, relative to CPI, a very similar picture is painted. It once again highlights how significant and generally quite accurate existing home sales data is as a leading indicator of house prices. The decline that we have seen in new homes being sold by home builders is not so dramatic. However, new homes only make up 590,000 home sales annually compared to the 3.7 million existing home sales annually. And the new home market has been heavily propped up by home builder incentives, which are allowing people to buy homes who would not ordinarily be able to afford it in free market conditions. This includes slashing the base prices on new homes, mortgage rate buy-downs, as well as permanent or temporary interest rate reductions on mortgages. And all of these incentives have become popular tactics amongst various large home builders to subsidise the purchase of a new home for buyers and artificially pumping up home demand. This somewhat artificial demand that these home builders have created in the market is no doubt contributing to keeping new home sales up higher than they maybe should be, and therefore propping up the housing market. Another major thing to bear in mind is that home price declines happen during recessions, and the housing market has historically seen the majority of down years take place during a recession. We are not yet officially in a recession, however some of the most accurate indicators for predicting a recession are signalling that one is coming soon, or that we are already in one but don't know it yet. This includes the bond yield curve inverting, as well as the Conference Board's Leading Economic Indicators Index reaching the -5% threshold on a year-over-year percentage change basis. Both of these indicators have correlated almost perfectly with every historic recession and are both right now pointing towards an imminent recession. A weakening job market is another key driving factor behind when and how severe the next recession will be, and it is also an important component of housing market performance. Right now, we're starting to see cracks emerge in the job market, with job openings declining quite sharply. Corporations are also facing a massive wall of debt maturing over the next couple of years, which is likely to saddle them with debt repayment costs, which will limit growth and could add to layoffs. Strategists do estimate that this corporate debt maturity wall could cut 5,000 payrolls a month in 2024, growing to 10,000 a month in 2025. The unemployment rate is a lagging variable that follows the federal funds base interest rate with a strong correlation. And as the federal funds rate rises, unemployment tends to start rising to follow it several years later, and we can see that this relationship has remained consistent throughout decades of historic economic data. It's been close to 2 years now since interest rate hikes began, as we can see that the first major rate hike took place in April of 2022, and since then we have witnessed rates be hiked at a record-breaking speed. This historic relationship therefore tells us that it is likely that we start to see the unemployment rate surge at some point in the next couple of years, and this could potentially begin in 2024. With a rise in people being laid off and no longer having any income coming in every month, we are likely to see a rise in housing foreclosures. And in fact, we are already starting to see foreclosures increase, which is not a good thing to see, considering that the unemployment rate remains at historic low levels of 3.7% right now. If we do therefore see the unemployment rate rise significantly in the coming year or so, then we are going to see the number of housing foreclosures shoot upwards. And this is especially likely considering the vulnerable financial position that many homeowners are in right now, with credit card debt at all-time highs and the personal savings rate being very low relative to recent history. We also still have a record high number of housing units under construction at 1.68 million units, which far exceeds the peak number that we saw in 2006, just before the global financial crisis. A lot of development projects got started with construction in 2020 and 2021 during the pandemic, when interest rates were very low and a lot of people wanted to move to larger homes to work from home. Due to the various material shortages that we saw though from constrained supply chains, there is a large backlog of units that are still under construction, and this backlog from a few years ago is contributing to these record high numbers that we see today. This is therefore going to lead to a massive glut of supply that is set to be offloaded by home builders onto the market in the coming years when these construction projects do get finished. And when you factor this into the current housing market conditions, with home prices and mortgage rates being sky high and affordability being extremely low, this tidal wave of supply may not have the demand to match it and will therefore keep putting downwards pressure on home prices. Of course, we are likely to see more homebuilder incentives continue to be offered to convert potential buyers who might fall slightly below the affordability criteria into sales. However, there's still only so many extra buyers that you can get through the door before home prices have to give way from the sheer volume of new homes that are set to be pumped onto the market in the coming years. There are also a number of key economic signals that are pointing towards big trouble ahead in the wider economy, which could also impact the housing market as well. I cover this topic in more detail in my previous video, which you can check out by clicking on screen right now. Aside from that, please leave a like on the video and subscribe if you enjoyed it. That does help out the channel a lot, and thanks a lot for watching.